Hey everyone, this is Rob Roy, and welcome to the weekend update. The markets just closed on Friday, July 7th, and if you attended our live Q&A earlier, today we had a complete reversal of the markets right after we did our live update. I don't know if we jinxed the market or what, but you're currently watching the market update. So again, go over to Hub Financial channel if you want to watch that Q&A, or if you have a question that you'd like to ask in a live format. So taking a look at the markets, basically it's gap filling, right? That's what's occurred over the past couple of days. We had the move down yesterday, which filled that gap to the upside that occurred on Friday. And so then we had the closing of the gap today. And gap filling is a conversation that comes up a lot. On your screen, you're seeing a graphic that came from thestreet.com, which basically says 9 out of 10 gaps get filled. We actually ran our own data on that, and we came up with 94% of gaps get filled. So the majority of gaps do get filled, but the caveat that's left there is you don't know when. Some gaps get filled immediately, just like these did. Other gaps take a little bit longer to get filled, and sometimes can take quite a while. So that's the issue, is you don't always know when, but it's something you have to keep in the back of your mind. If you've watched any of these recordings, you've heard me talk about gaps a lot. So think about them. The quotes there on the street.com article is they act like magnets. You've heard me use the tractor beam analogy with the whole Star Trek analogy, etc. Well, what we learned is these gaps got filled rather quickly. The news yesterday, which created the move to the downside, was we had the ADP, the private sector jobs report that came out, and it showed nearly twice as many jobs were as expected were created, and that was a bit of a negative due to the fact that that's one of the Fed's mandates. They're trying to bring the job market down. They feel that's one of the fuels of inflation, and so they want to bring that down. So the fact that the ADP report showed so many jobs being added, it was viewed as a negative. So we traded down, but we closed near the high of the day. Well, then this morning, we get the non-farm payrolls number. That's the government's number. And that number showed fewer than expected jobs were added. So, the two are, do you believe the private sector? Do you believe the government's number? But it allowed the market to rally, at least for the good part of the day, as I said, all the way up to our live Q&A. But look what we did. We filled the gap, but then closed near the low of the day. So with all that said, where does that leave us? Well, it leaves us with the market closing right smack on the 10-day moving average. Both those gaps have been filled, so there's no more concern about the gaps. But where do we go from here? I know that's what everybody wants to know. And the key is that we have to break above this wave 3 high. So we hit that level back on the 15th of June, and we tested it there on the 30th. We tested it on the 3rd of July, and then we filled the gaps over the past couple of trading days. So we're right here on these 10-day moving average levels. And I think if you're bullish, you want to see a break above this wave 3 high. I don't think that you want to go long right now until you see that, due to the fact that we did finish on the lows today, which means the beginning of next week is going to be quite interesting. And speaking of gaps, we still have one way back down here towards 420 that hasn't been filled yet. At some point, we are going to have a correction. We are going to have that wave 4. And I'd also been talking about once we got past that end of quarter, once we got past the window dressing, and we had a really weird start to the week where we had new money usually goes to work on the first trading day of the month. That's money that's being put into IRAs, 401ks, et cetera. Investment managers put that money to work on the first trading day of the month, but that happened to be a half a day before the July 4th holiday. So was that going to go to work on Monday? Was it going to work on Wednesday? Well, we're past all that stuff now. We're a week into July, and now we're going to find out. Is the market going to break above these highs and take off on a run? The Elliott Wave algorithm likes that 460 level. So at some point, we're probably going there. But the question is, does the wave 3 extend to that level? Then we correct, or do we correct first and then move up to that wave 5 level? I'm curious, what do you think? Leave a comment. Do you think the market rallies to 460 first and then corrects, or do we correct first and then rally towards that 460 level. So again, really interested to hear what your thoughts may be along those lines. We haven't looked at a weekly chart in a while of the markets, so I thought, hey, let's go ahead and take a look at a weekly chart of the S&P. And when you can see here, the line moved over from the daily chart, and we don't have a 5-wave labeled pattern any longer on the weekly chart, which is really interesting. So you can see that we have this triangle pattern here on the weekly chart. Kind of tough to trade a triangle on a weekly chart because it's just too far out in time, but an upside breakout towards that level. And then if you look at the weekly chart, you can see there's resistance at what level? 460, the same level that the Elliott Wave algorithm is saying is a likely target on the daily chart. Again, we don't know whether that comes sooner rather than later. I tend to think that it would be an easier market trade if we rallied up there first, because I feel like when we get into the end of quarter earnings reports, we're going to start to see some more negative reports as the inflation and et cetera starts to take hold. Last quarter's earnings were a bit better than I thought they were going to be, but I really feel like we're going to have that come in at some point in time. When you look at the 10-year on the interest rates, we've been talking about this for quite some time, this level between 34 and 40, which I've been calling the sweet spot on rates. In other words, it was an area where even as rates elevated, it would still be okay for tech stocks that are more rate sensitive. But we've broken above that level and we close right there. So there really wasn't a follow through today. So today's close, you'll see a dot right there at 40.5, exactly where we closed yesterday. So no big follow through on rates. And the question will become next week, do we break back down? Because there's another one of those gaps. Do we break back down and fill that gap and get below that? That could give a boost to the NASDAQ and the tech stocks next week. But if we take off running with rates, and all we need is a little bit of follow through from this 41 level, I think that's negative for not just tech stocks, but the market in general. We've been talking about the yield curve for quite some time. It did invert again past 100 basis points. You can see the craziness in the curve. Money moving back into money markets, because look, you can get nearly 5% on a 2-year. So is money going to move into the bonds? Well, so far it hasn't been pouring in, or we would have seen rates go to the downside rather than the upside. But at what point does that flip? At what point do people start to say, hey, I don't want the risk of the equities market? But I think we've had this move to the upside. We've had all the headlines with the tech stocks and anything AI based. And so far, people are still wanting to chase the higher performance in the equities market. But you certainly have to keep in the back of your mind that money could say, a little bit concerned about the second half of the year. The Fed has been super hawkish. There's no more rate cuts. The Fed Fund Futures forecast for a rate cut is gone for the end of the year. And they said at least 2 more rate hikes. So, at some point you could see where money maybe start to move into the bond market and leave the equities market. And that could create that correction we were talking about. The dollar is just doing absolutely nothing, just sitting here in this consolidating triangle here. All I can say is at some point we're going to get a breakout in the dollar. That will affect metals. Metals have been just kind of waiting to see where the dollar is going to go. You can see this mark here from today. We're just dead in the point of the triangle. So does the dollar break to the upside? That's going to take any hope of a bid in the metals away. But if the dollar breaks to the downside, and if it could follow through and break all the way below 101, then I think the metals are a place that you want to be. So with that said, I thought I'd go ahead and show you the SLV, and you can see we've just been consolidating here. The metals have been consolidating while the dollar is consolidating in that triangle, waiting for the breakout. This wave 4 has retraced 83%. That disqualifies that 5-wave to the upside pattern, which leads you to believe that, if the market, as far as the dollar is concerned, breaks higher, then the metals break down. And you can see, just take a look at that chart where support and resistance is. So if we were to take off with the metals and the SLV, particularly with what we're looking for, you don't run into resistance until you hit 24. If the dollar were to break to the upside and the metals break lower, then there's your support down there around 18.5. So consolidation here, waiting on the dollar to tell us which way the metals are going to go, but there's a trade there either way. So if the dollar breaks to the upside, you can short the metals. If the dollar breaks to the downside, you can go long the metals. That's something to watch for next week as well and see how that plays out. Looking at the VIX, we mentioned this in the last recording that we did. We were off last week, but 2 weeks ago, we talked about how with this settling down here, you would think that we would at least need to go up and test that area around 17 that had been support for so long. We broke below it. Old support becomes new resistance. And we got that yesterday. We actually hit 17 on the high, closed down below that, closing right at 15 at today's close on the VIX. So does that mean we start to work our way down towards 12? We still have that 61.8% level there on 5. Some people ask questions, why would you show an Elliott Wave pattern on the VIX? It's a pattern. And so that's what Elliott Wave is doing, is identifying points on the pattern. So we would have to break that 61.8% level. But right now, we've almost kind of moved, we've created a bit of a trading range atmosphere here between the lows just under 14 and that resistance at 17. What happens if we trade in this range? The market could do anything. A break above 17 on the VIX, and we're probably correcting in the market. A break below this 13.5 level, and that may give us that run towards 460 on the equities market. So we're in a point where I know everybody wants to say or wants to know what direction are we going, but we're in one of those wait and see modes. Sometimes the best trade is no trade, and I feel like that's where we are right now. Let's let these things play out. I don't think we're going to have to wait much longer to get these answers, and then we have some pretty easy trades to make from there when the market starts moving. Looking at the DIA, also moving to the downside today. We do have a 5-wave qualified pattern to the upside here as well. Resistance being up there at 345. You can see all that resistance. So we tried to do it there towards the end of June, got turned back. We put the 10-day moving average on. We broke below it, but look where we closed today, dead on the 50-day moving average on the DIA. Now, the positive, if you're bullish on the Dow, is we do have a set of higher lows, actually creating a bit of an ascending triangle pattern on the DIA. Something's going to happen here. We're going to get some sort of a break here on the DIA. But to be bullish, you need to see it above 345. To be bearish, we got to break that 50-day moving average and break this down trend line. I don't think we have to take out these lows of May, but if we break down below this trend line, you can start to look to be bearish on the DIA. But since we're in this triangle, let's let one of these trend lines get broken. The cues that we talked about during the live broadcast at 2 p.m. Eastern time also filled the gap, and really not as bad of action out of the cues as you might have thought with that big break above 40 on the TNX. Could have thought, we might have had an uglier day. It's almost like the NASDAQ isn't really believing that rate move is going to continue higher, at least not yet. And so we look here at these levels, and the same type of scenario here. We're so close to resistance. You're just guessing, I think, at this point on where we go from here. And if we look at the 10-day moving average, also closing right there on top of the 10-day moving average, and look where that wave 4. Man, if we break down below this level, we're probably coming down all the way down towards 320, which happens to intersect that wave 4 forecast if the wave 4 were to begin now. So can we break above resistance? Can we get that next leg higher now? Or are we in corrective mode? These resistance levels hold and we break to the downside, move lower. At least we have an idea where things are going to go either way. But as I said before, I think we need to wait and let these levels get either broken, or we need to see the markets break down. They've pulled back. They filled the gaps. They haven't fully broken down, but they haven't broken resistance either. And then looking at the IWM, a lot of people, we talked about this last night in our insiders meeting for our alert subscribers only at evotrader.com. And by the way, we closed out a lot of of really good case study considerations from TradeFinder on Tuesday night. We've had a heck of a run there on identifying case studies, but in TradeFinder, you're on your own. With the alert service, we send you out alerts for entries, any adjustments, and exits. But we're looking at the IWM last night. A lot of people look at the small caps for a read on risk reward. We've had this 170 to 180 range for quite some time. The big range was 170 to 190. That's going back over a year. We broke above 180. We thought, hey, we need to test that 180. It did that. So we came up and we looked at this 190 level and we tested it twice now. Weren't able to break above it. Now we're back down looking to test 180. We had moved higher today on that non-farm payrolls report. Also filled the gap and then closed dead smack in the middle of the bar right at 185. So are we coming down to 180 again? Are we going up to 190 again? This is another scenario where I'm saying, pausing at the beginning of next week from a trading standpoint is probably the most prudent thing to do, and wait for these levels to get broken. If we break above 190, which is where this wave 5 pattern suggests we're going to go, you can see exactly where we're going, right to that previous high from the beginning of February, coincides, intersects that wave 5 forecasted price there. So if we can get above 190, we probably go up from 195 towards 200. Now the old range was 190 to 210, but that's going back a couple years. And we'll have to see if we can get above 190 first, because we may break back below 180 and move back into this range between 170 and 190. There's too many unknowns right now. So this is the time when you just become cautious. Wait, let the market tell you where it's going to go, keep the powder dry, and then when we get these signals, then we can pounce, and then we can take advantage of directional moves from there. Did want to show you a couple international markets before we wrap things up for this Friday. The INDA staying really strong here, just an amazing 45-degree angle, the exact pattern that I prefer for trending patterns. If you had to design it for the best trending pattern, that's it, 45 degrees. And the reason for that is we all know the markets move in impulses and corrections. That's the whole gist of what Elliott Wave is, identifying impulses and corrections. But when you move in a 45-degree angle in the trend, the corrections are not as severe. And you can see here the corrections were not as severe. So running straight through the upside here, and we had a little bit of a pullback, but we were able to recover it to finish off the week. Still looks really strong. Definitely the best looking of any of the markets, I think, not just the U.S., but globally. The INDA, it doesn't look like that's over with. As long as we can stay above the 10-day moving average, I think you can stay long the INDA. And in the not too distant future, we're probably looking at the INDA hitting that 5 target there around 45.5. It can be an extended 3 or a correction and then a 5. It seems to be here that perhaps we're going to continue on that wave 3. You look at the DMI and it's still fairly supportive of a continued move to the upside. Looking at the Aussie market, we talked about this last night in our insiders meeting as well. We have a lot of Australian subscribers at evotrader.com. And we said 22 needed to hold, and it had broken below it. Well, it got back above it to end the week. So that was really important to see that 22 level hold one more time. And we look at the Elliott Wave pattern here. You can see there is no qualified 5-wave pattern. So we're in corrective mode, which makes sense. Notice the past few times that we've tried to break below. So we broke above it back in November. So then 22 became support. We broke down below it the 22nd of December, the 3rd of January, a couple times here in March, again in May, but not one of those times did we get a follow-through day to the downside. You hear us talk about it all the time. When you break a level, you have to have a follow-through day or confirmation day, and we didn't get it this time either. So can the Aussie market hold there on the EWA above 22 is going to be key. If it can, then perhaps we can look to move back up towards resistance, which is at 23. So perhaps a trading range, maybe here short term, but for now, staved off what could have been kind of ugly in the Aussie market, because when you look at this chart, this was such a big run, almost a vertical run going back from the October lows, that if we can't hold 22, there's a big void there, and that would be a pretty bearish trade all the way down to around 19.5. Thought I'd just go ahead and show you the emerging markets here in general, and a bit of an upward move to end the week when the emerging markets had looked a bit rough with what we did yesterday. The old expression is that when the U.S. sneezes, the world catches a cold, the global markets. But hey, they performed very well today, moving back up, filling their gap as well. And as long as the EEM can hold above this 38 level, perhaps that's an area that you want to be. Look at this pattern, the wave 4 right there at the 61.8% fib level that held and move back to the upside. So we'll be watching that next week, but there's going to be resistance here at 41. That'll be key on the EEM. And then last, but certainly not least, Bitcoin. And we've been talking about this, that Bitcoin, you didn't want it to run above 31,000 after this big vertical move here, because that likely wouldn't hold. When you get a break above a resistance area, and 31,000 has that resistance from those highs back in April, it tends not to hold. But we've done exactly what you would like to see occur here. We've gone sideways and consolidated this vertical move, and I think we've done it long enough, allowing the 10-day moving average to catch up. We're just above 30,000 at the time of this recording. I know trades 24/7. If you're new watching this, I get that, but we do get end-of-day quotes here for software programs such as this, which is the Hub software. If you want to learn more about this software, you can go to hubb.com. I think it's the best Elliott Wave software that exists. So if we can break above this 31,000 level now, we might be off and running on Bitcoin. So we've done what we needed to do, I feel like. But a break down below 30,000, all bets are off. But with this consolidation, if we can start next week and get a run in Bitcoin, get a break above 31,000 with follow through, I think that's the place you want to look. The cryptos, they've held in pretty darn well. So thanks for spending a little bit of your weekend with us. Have a great rest of your weekend. Look forward to talking to you again next week. Take care, everybody.
If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.